In this series, I've consistently talked about how liquidity is the most important thing to understand if you want to be a successful day trader. But in today's video, I'm going to talk about false or bad draws on liquidity, aka areas where you should never take a trade targeting that specific spot. So we're going to go over a few examples of why certain areas or why certain highs, lows, whatever it might be, are not going to be a good target or draw on liquidity. And I'm going to back that up with the reasoning. Now, I do apologize. I am a little bit sick right now. This is the last segment for now of this boot camp, and I filmed it after all the other ones, and I feel like crap. So, yeah, hopefully I feel better by Christmas, but let's get right into it. So, the first bad draw on liquidity that you should never use is a protected high or a protected low. Now, what exactly does this mean? Okay, well, here's what it means. It basically refers to a high that was formed in the process of taking out the most other recent highs around. So you see this set of swing highs right here, right? You might recognize this chart because I used it for the example of liquidity definition in the first video of this bootcamp. But like I said, and I also apologize if I sound like I'm sniffling and stuff, it's because I am. I can't really control it. But basically, we never want to target a protected high, right? And I will mark it out, protected high. Okay, so what a protected high is, like I said, is a high formed in the process of taking out buy side, right? So we have taken out all of this buy side that was bringing the market up to begin with. So even though we created a new high right here, you would not expect that to get revisited, at least immediately, right? Because that was a liquidity sweep. That was the stop hunt, right? So there's no reason to rehunt that stop hunt. The only time we can actually use that as a good target is in an example like this, right? Where market moves around down here and creates more buy side while it moves down. You know, you end up taking out this low or something, which we actually do. And then you can use that high as a final swing point. But the idea is you only target that then because you've created more buy side due to the move down off of this. Now, the very important clarification here is that just because this is not a good target, right? Just because the protected high should give us a reversal and we shouldn't go back to it until we generate more buy side, doesn't mean we're not going to, right? You will see cases in the market where we have a liquidity sweep and then we go up and do the whole thing over again. And we'll either break out or we'll just have another liquidity sweep. And obviously the market can be unpredictable at times. No matter how much you know, no matter how good your strategy is, you are going to have trades that just don't pan out the way you would have drew it up, which is fine. The only point I'm making here is not that because this is a protected high, we can never revisit it before generating more buy side, right? We can absolutely V-shape back up and, you know, take out that new high that was just a liquidity sweep in and of itself. But are the odds of that likely? No. Can you rationally justify targeting that high that was just the stop raid right before you even make any more buy side or take any of the opposing sell side? No, you can't justify that, which is why protected highs are not good to take trades on when you're targeting them. Only when there are other points of obvious buy side in the range, but especially when you sweep highs like this, you want to at least first look for some move to take sell side before even considering taking a trade up to a protected high, right? Real quick, if you're enjoying this video, make sure to like and subscribe so you see more of my stuff. I post educational content all the time with the goal of helping traders become better. Enjoy the rest of the video. So like I said, you do not want to be targeting protected highs. Does it mean the market can't go right back up to a protected high and take it immediately? No, it doesn't mean that. It just means that it's a low probability target that's not going to get you consistent or logical results, right? Because you can't justify this being a better target than the sell side after we've already taken all the buy side in the range. You can even use this concept in fair value gaps. So that's one of the biggest times where you want to pay attention to it, right? Because notice how right here on this 4-hour gap, and I keep coming back to this one because it's a very textbook example. You have this obvious fair value gap, right? You have a low inside of it, okay? So you put in this low, then you put in a higher low, but it's more liquidity, so you can actually start to expect us to come down and take it all. So we do, right? But now we have this low that we put in, right after sweeping out other swing lows inside of a bullish gap. So not only is this an imbalanced low, but it's an imbalanced low that took out another low inside of a bullish gap. And a lot of times those aren't going to get revisited. And even if they do, it's just a horrible target to use as your thesis for a trade, right? Once again, a lot of these areas that I'm talking about, I'm pointing out, yes, they can be returned to. Yes, news events can happen, whatever. Like the market can move in weird ways to where you'd push price in a direction in many cases where nobody, using liquidity to rationalize their trades would have expected it. But those are the exceptions, right? Those are the exceptions to the rule. If you are playing liquidity and your thesis is that market moves from buy side to sell side to buy side, whatever, to take out stops in one direction to then revisit the other, take out stops in that direction, then if you take out stops in one direction, like these lows right here, then why would you immediately look to short again, right? Because now we've created all of this buy side that actually needs to be taken. So even if you were higher time frame bearish here, you would at least want to wait till all of that gets ran to even think about shorting, right? So this is a really good example. Protected highs, protected lows, and then protected imbalance highs and lows as well, right? They're just protected highs or lows inside of a fair value gap, which is very important. Now, the next one, I probably won't be able to find an example of it right like off the bat, so I'm just going to draw it, but it's basically SMTs. Damn, I had to blow my nose, but it's basically SMTs at your draw on liquidity. Okay, so I'm going to give you guys an example right here. Say that we have on ES and NQ, and for those of you who don't know, an SMT is just a divergence between two assets that are supposed to correlate, right? So ES and NQ are supposed to correlate, right? The NASDAQ, the S&P 500, those are the two things I trade the most. There's SMTs you can use between gold and silver, SMTs you can use between Bitcoin and Ethereum, right? Like any correlating assets. But basically, you're looking for a divergence. So say that we have relative equal highs that are very obvious on NQ, right? And say we also have those very obvious relative equal highs on ES. Now, this is a situation that can happen often where you'll have one side take the draw on liquidity and you'll be in a trade on the other. So like I said, say that this is NQ and you're long NQ from this low, right? You swept liquidity, so you get long, right? We have this liquidity sweep right here. You get long, targeting the relative equal highs. And you notice the momentum start to fade, right? So yes, the relative equal highs haven't been taken, so you would expect them to be returned to pretty quickly, right? You'd expect the price to just finally make that last push up. But what you have to do in these cases, especially if you're looking at higher time frames, right? If you're looking at highs on the 4-hour, the daily especially, right? If you see, for this example, you're long NQ and you see that ES has already taken those highs and that's starting to reverse too, you can start to infer that, okay, maybe the market's actually just looking to push lower here. NQ was too weak to even sweep those highs, but ES took that buy side and is now reacting off it the way you would have expected NASDAQ to if we had taken it, but we haven't even taken it. So why is it going down, right? And you have to be paying attention to this because like I said, does this mean that we won't just boom, rip back up and then actually finally take the highs on NQ as well? Of course, it doesn't mean that in every case, but this is the point if you're long where you want to at least be de-risking, right? Whether that's a trim, whether that's trailing your stop, whether that's just exiting the position completely. I'll tell you guys that depending on the reaction I see, right? Like if we start to get a very severe dump after taking out a draw on whatever index I'm not in and we haven't taken it on the one I'm in, so a lot of times I just close the trade, honestly, because it's a pretty bad look. And if the market was really strong, you would expect them to take it at about the same time or to just cause or create like displacement through these highs on ES and then finally take them on NQ, right? So like all those things you need to be paying attention to. So to summarize this video, right? And this is, I'll just do this right here, right? ES, NQ, okay? So if ES takes the high and NQ does not, and you're long, you might want to consider modifying your trade, right? And same vice versa. If you're long ES and it doesn't take the high, but NQ does, right? Something like this, you might want to consider modifying the trade, right? Which can mean whatever your risk protocol is. I'm not here to tell you guys what to do with that. I'm just here trying to teach you market basics, technicals, all that stuff. So with that being said, I hope you guys enjoyed this video on what liquidity not to use or when to stop taking a certain point as seriously as you were, like I said with this example. And that's going to be it for now for this boot camp. Now, I might do another series, but this was never going to be like some TJR style where it's like hundreds of hours and, a ton of episodes, like longer than a Netflix series. This was always just going to be probably like a 30 to 50-minute total series, little mini series where I explain liquidity as best I can to help you guys understand it as best you can, right? And that's kind of the goal. Now, if you just found this video and you haven't watched the entire liquidity bootcamp, I would definitely recommend you do, because it's going to be very, very important for you to understand even half the things I'm talking about in this video or other concepts, right? Like, it's a 5-part series as of now, and each video has a concept that I continue to build on, and you need that context. So if this video kind of confused you, but you stuck through it and you haven't watched the other episodes, totally do that. I would really recommend it, because like I said, I do think it will help you guys get a great understanding of everything I've talked about. So yeah, I appreciate you all for watching. Make sure to click the link in my well, it's in my YouTube bio. I'll put it in the description as well for my free trading Discord. No credit card, no email, none of that BS. Literally just click the link and you are in. And I post my market commentary, interact with you guys, take content suggestions. So whatever you want it to be, I can lock in and do it. And yeah, I appreciate you all for watching. I'll catch you in the next one. Peace.